Can't hear anything.
All right, so we have everyone just joining in. We're going to wait a couple more minutes before we get going. And really excited to have so many of you with us here today.
Ian.
Hi, Yost.
Hey.
Just a friendly reminder as everyone logs on, if you can please mute your microphone in the lower left section, that would be great.
Just to mute the microphone in the lower left section.
On my iPad.
Mute your mics.
All right, well, good afternoon, everyone. And thank you for joining us today. My name is Dr. Ian Sandler, and I am the CEO of Grey Wolf Animal Health in Toronto. We are a Canadian specialty animal health company focused on improving the lives and well-being of vets and pets in Canada and abroad. We are honored to help sponsor today's webinar. We are thrilled that you can join us today to hear from our dynamic panel on navigating the financial implications of the COVID-19 crisis on veterinary medicine in Canada. Before I introduce our speakers today, I would like to thank the CVMA for their extraordinary leadership in this time. Time. In many ways, our two speakers today require very little introduction. Dr. John Tate is a veterinarian and veterinary business consultant that is well known internationally. He is one of only 2 Canadians to be a past president of the American Animal Hospital Association. John is also a certified financial planner, business valuator, and mediator. And I had the pleasure of working with John for over 16 years during our time together at the Ontario Veterinary Group. Dave Legault is a partner and CPA at Ward and Upton Grove in Listoyle, Ontario. Dave has developed the Veterinary Advisory Group at his firm and has tailored his practice to veterinarians across Canada. He is extremely knowledgeable in several business valuations, restructuring, just to name a few. Dave is incredibly personable and client-focused. Before I pass the floor over to the speakers, and specifically to Dr. Tate, I ask that you please ensure that your microphones are muted, even if you are not speaking. I know that many of you have sent in questions today. There is a lot of content for us to cover, and we will hopefully get to all of them. If you do have any questions during the webinar, please feel free to list them on the chat section. If we have time at the end, we will certainly try and address them. This webinar will be archived and available for viewing, as well as the content from our speakers. And without further ado, I pass the mic over to Dr. John Tate.
Good. Thanks very much, Ian. And I would first like to thank the CVMA first for providing the forum for this platform. I think this across the country has certainly been a time where we've seen a lot of our associations step up with advice to members, and we thought we would consider this webinar a little bit differently than some of the information that is already out there. So appreciate everyone taking the time to attend during what is obviously a challenging time, and also thank you to Ian and Grey Wolf for also sponsoring this event too. So what I'm going to do, I'm going to jump right into my slides here. which you should be seeing. You're seeing those okay, Ian? So what I wanted to start with was just looking at some of the frequently asked questions that we have had that go outside of a lot of the advice that's out there on day-to-day operations and government support programs. Dave's going to talk a little bit about those as well. And what I like to cover in my content section, just very briefly, touch on managing now and what to prioritize, what are the various ways to respond with staff models, and then move very quickly into the financial side of things about covering expenses. I think that there's a lot of questions have come in, certainly I've been dealing with a lot of them about how do I manage my practice on a day-to-day basis? How do I know I'm covering my expenses? I'm going to go over a very quick calculation with you on that. Other questions that have come in look beyond the current crisis period, with the average practice owner in Canada and the US now slightly over 60 years old. This is a very busy transition marketplace. And for many of us, or many of you as practice owners, the last thing you wanted to see was a dent in the productivity and value of your practice and change in the activity of the market of some of the consolidation and so on. I've had a chance to talk to all of the main consolidators, and as well we've reestablished, or I'm going to show you kind of the norms in business valuation as well. And finally end with a little bit of positive news, I think, on the economic side. I think we see lots of negative in the media, so I'd like to end with a little bit of positive news as well. So when we look at communication and employee safety and so on, this to me, I think, is the place where we have seen a lot of information from our associations and so on already. They've done an excellent job, CVMA and provincial associations, in terms of what programs are out there, what support programs are out there, and so on as well. What I tend to like actually is something that allows you to respond on a situational basis, and what you should be seeing now is just something that looks at the most common situations you might find with prevalence in the area. It's all color coded and everything. I'm not going to go through this, but essentially based on the various common situations that happens with presence in your staff withdrawing, community presence, and so on at various levels, this document was created, coded kind of like as though we'd had some kind of a war or something. So it's a bit over the top maybe on that, but essentially I find it's a good guide for practices to say, you know, we've had a team member diagnosed, what do we do now? We've had team members that have multiple practices with multiple team members diagnosed, and what this grid does is just advances the severity of the situation with your staff in the practice and how you can manage it and how you can manage your practice. I'm not going to go through that in detail because these resources will be available. And I think there's a lot out of there on day to day as well, only to show it in a little bit different context as well in terms of what is out there. So I think we've seen a lot of client and patient safety recommendations. I think a lot of practices have adopted their operating models as in terms of defining what is urgent and what is not urgent. I would just encourage going by those guidelines. There's a little bit of professional discretion and so on in there as well. Probably many of you are doing this as well. What I would like to do, though, is kind of jump into more of the financial angle of things with kind of a yes and no. I'm getting a number of questions. Should I do this? Should I do that? How do I calculate this? How do I calculate that? I think no question, as revenue drops, and it's safe to say most practices have experienced a drop in revenue, one of the most important considerations is to try not to put your practice into credit and to try not to increase the debt load or the liability side of your balance sheet, but adopt your operating model to the current practice performance. And what I would like to show you is this. And this is essentially a very simple, easy to use, daily basis, weekly basis, whatever you would like, break-even sheet. And what I would encourage you to do is just fill this out and you can adapt it. And I'll show you how it works. In practice, we have fixed costs and variable costs. Variable costs here are ones that typically will float a little bit with the revenue of the practice, nothing bigger than cost of goods. And with us not turning over as much wellness supplies and likely seeing our peak so-called heartworm season be delayed a little bit here, frankly, I think every practice should be well into the low 20s, if not below that, in terms of their cost of goods %. So you can look back on your old P&Ls and determine as a percent of revenue what this handful of expenses would have been as a percent. The second step then is to look at all of your fixed costs here. And these are the fixed costs, and all you need to do in this is fill in the green square. So if a practice had a loan of $6,000 a month and an equipment lease, and they had to pay rent, and they had various service contracts, and they had to pay taxes and insurance, and a couple utilities, whether it's hydro or water, whatever it is, and all of these other expenses that are typically fixed costs, including their veterinarians and their labor, what this break-even calculation will do at the end of the day based on the number of days per week you're open and the number of days per year that you are closed, is it will simply calculate for you, looking at your variable cost total percent and all of your fixed costs, right down here in the bottom square, what your practice needs to do right now to break even and cover the expenses and not have to dive deeper into credit or any kind of debt. So let's say that this practice simply cannot do $3,330 per day. Well, this is where the concept of cutting backs and layoffs and deferring debt comes in. So if I reduce this loan to zero, and if say I'm going to have to unfortunately lay off some of my staff and they are reduced, say I'm cutting back one vet to $2,000 a month, and I'm also going to take a couple of my staff members over here and I'm going to reduce them to zero and maybe cut back my hours on this one, then you can experiment a little bit, because what the calculation will do is to say, okay, right now, based on the layoffs that you are considering, your practice only needs to generate $1,600 a day, down from $3,300. Because we see some day-to-day volatility, I'm not a big fan necessarily of doing this every day, unless you happen to like to track it every day, but it calculates a break-even point. And I think it's a very critical financial metric during a downturn and increased volatility that practices can do, frankly, in just a few minutes. And you can also do it on a speculative basis. And then as the practice starts to come back up, and we will have a recovery, then it'll be possible to adjust the revenue and bring your staff complement back up such that you are making your break-even point. So I think a couple of yeses would be to do that as your revenue fluctuates. If you do have long-term liabilities, whether it's a term loan or a mortgage or whatever it is, I think the idea of deferring them, if you know you cannot hit your break-even point, is a good idea. A couple of quick things to check on though, and different banks are handling it different ways. One is try and get confirmation from the bank that that deferral is not going to affect your credit rating down the road, because it could. Some of the structure of loans may affect credit ratings down the road. So when practices come for whatever reason to respond or ask for future credit, they should not, in all fairness, get dinged by their credit rating. The other thing is if somebody, say, has a 3-year loan and you're 6 months into it and the bank gives you a 6 or an 8-month deferral, then one thing you should confirm with them is that when that loan kicks back in, you have the option to re-amortize it over the initial period. Because I think it's going to be tough on practices if they're dealing with banks who say, well, we gave you a 6-month deferral. Now we want the balance of our loan in the remaining term. So we're now going to put increased cash flow pressure on you. And that could be a stressor for practices. So what I have seen for practices I've been helping is they've been able to get an extension of their loan, an indication from the bank that they will allow you to re-amortize it, and that it will be excluded from any future credit rating calculations for the business of the individual, regardless of who holds it. The third thing would be the idea of extending credit. Most practices have operating lines of credit. Banks are being great, frankly, most of them, particularly with their eyes on the veterinary sector, about extending those lines of credit. And if you can, and again, some are more cooperative than others, try and secure your line of credit. What does that mean? That when a monthly payment comes due on a line of credit, if it is not secured, then the bank will ask for a percentage of the principal that you have on the line of credit. So say if you had a $100,000 line of credit, you have $80,000 on it. First of all, you should be able to get more in any mid-sized to larger practice, even a small one above that amount. But they'll ask for a chunk of that 80,000. If it's secured, your only current liability will be the interest. And let's face it, we're not paying much interest now, which is a good thing. Finally, the third thing, many of our vendors will extend trade credit. And that means buy now, pay in 60 days, pay in 90 days, whatever it is. I think it's a good idea if you are in a tight cash flow position, use the trade credit. Doesn't cost anybody anything. At some of the purchasing companies, you might lose a 2% discount, but at the same time, that trade credit can also be very valuable as well. I think in terms of extra credit and wellness plans, those right now, be careful with anything that defers payment on the part of clients. Managing accounts receivable is going to be a key thing. If you're providing an employee match for RRSPs or whatever it is, healthcare savings account programs, and money to health insurance companies and insurance companies and so on that are putting these group plans out will allow deferrals as well. And of course, some of the discretionary stuff, I would suspend that as well. Asked the question a lot of, should I offer discounts right now to clients? My feeling is now, our compliance is not based currently on discounts. It's based on logistics. It's based on state of anxiety. It's based on defining what's urgent or not. And where clients are prioritizing these expenditures, it is not based on discounts. I think it could be during the recovery stage, but at this point, again, we don't have any indication, certainly some of the research coming out of the US, that clients are responding in any significant way to current discounts. The opposite of that, I'll show you here in a second. I would not consider diluting your equity with private capital coming in. That may give you an infusion of capital. And there is a lot of private capital out there now, which is, I think, a good news story. But the internal rate of return, they may want long-term to invest in your practice, may not be worth it compared to some of these other more conventional and easier to do and cheaper extensions of credit and access to cash. Finally, I've had a number of people say, should I be dragging my personal assets into this? Should I put a reverse mortgage on my home? Should I take money out of RRSPs or RESPs for my kids or my long-term investments? And the answer there really is no. That would be, to me, an absolute last resort because of the penalties and back-end loaded fees and interest rates and things you see on reverse mortgage. I mean, in extreme cases, anything is on the table, but this would be a last resort. Also, in terms of looking at saying, I just want to sell now, frankly, this is not the present time to sell. Doing anything in a state of panic or anxiety is never going to be good for the business. And again, try also, even though they've cut interest rates, avoiding credit card spending. If you are facing a possible shortfall, any capital spending or taking on of long-term debt, I would postpone that unless it's something that's absolutely needed. New leases and so on, principals on those leasing companies are deferring for 3 or 6 months on picking up a new lease. Certainly approaching a landlord for a temporary rate abatement if they're willing to do that. If you are really in need of an infusion of cash and you own your own real estate, it is possible to consider selling your real estate and then leasing it back from yourself essentially, but it does provide an infusion of cash. We are seeing some clients and some practices, actually I mentioned discounts, not to give them across the board. The only exception I would make to that where we've seen some success is if they do an accelerated payment like right away, where there's been a small discount for that rather than practices trying to bundle wellness plans and payment plans and statement billing and so on down the road as well. And finally, just the throw out a net to the market to try and raise additional debt. If you have a fair bit of equity in your practice, it is possible to borrow against that existing equity if something as simple as a credit line is not available to you. So for a number of owners that are thinking transition was on the horizon for me, or it's a lot closer now, or wherever it was, there is no question over the short term, and I've spoken or had feedback from 4 of the major consolidators here in Canada. They've all taken a slightly different position, but I think it's fair to say there's a bit of a pause in the market now. Some are better capitalized than others and are continuing to offer financial support and certainly reasonably good offers, but there definitely is some trend to risk shifting I think we're going to see over the short term. And these are some of the ones probably frankly for upwards of the next half a year or so on that we're going to see, depending on how quick a practice bounces back, that you may get a total payout, but not 100%. You may get 100% of the value of your practice, but you have to stay on for a period of time that would have been longer than previously, especially if you are an owner generating a considerable portion of the revenue. One of them at least is looking more at a joint venture type model where they won't take over the entire practice, but you have to stay in as a minority owner for a while. And then we have a number of what we call earnouts, where the ultimate payment of 100% of the value of a practice to a date before COVID hit will be based on the practice returning to the revenue point at some point in the future, or some consolidators are putting time limits on of upwards of a year or sometimes even 2 years. But I think what we can look at in the market over the short term is some risk shifting. But the consolidator concept in a business model that is built on growth is not going anywhere over the long term. These are AVMA stats just showing the demographics of supply and demand continue to be there in terms of the number of veterinarians that will retire over the short term as well. So this is just a chart I did on practice valuation. So just to kind of show the trend that we're looking at, if this is a practice that had $1 million value in December of 2019, and we jump forward to June of 2020, no question, I think the average practice, certainly doing companion animals in high incidence areas of COVID, is going to see a drop. I don't think it's unreasonable that some practices will see a temporary and significant drop. But in a conference call last week with the Council for Business Valuators based out of the US, but that applies everywhere, what we are recommending for business owners is the time frame on a future valuation to look at recovery really should arc about 6 months beyond the beginning of what we define as recovery. And I'm going to define that for you in a minute. And the slope of the upward recovery, like you see in this one here, is going to affect the future value. But a present value back here, a present value for anyone who is anchored to value, even in a summary or shorter form valuation, this value back here dated, say, pretty well any time up to the end of March 2020, would allow you to borrow against that and would provide an anchor for mitigating risk rather than one that has never had any kind of analytics done and is starting at a lower value. So if I go through a few of these slopes, this practice here, this time goes all the way back to December 2017. The reason I did that, in business valuation, we look at a weighted average over time. So by looking at 2017, 2018, 2019, and we're into 2020, and this practice takes a dip from close to $1 million all the way down to 650,000, but recovers that within 6 months. This area here, we are going to be able over time to largely normalize that out, or essentially discount it as a non-recurring event. So time counts when it comes to business value. This is an even better one, better case scenario, where the dip is still 20% of value. But again, by the end of the year, that practice has regained the equity it had and then grown, can be normalized out. This probably would be a lesser case scenario where a practice is struggling to recover. And our conversations with Grey Wolf and so on, and Dave Legault, who you'll hear from him and his team shortly with some more specific scenarios, our plan is to have a second webinar that will deal specifically with business recovery, the strategy, the tactics, the managing of the HR, finance, and marketing portfolios when we're in position to start doing that, because I think our delivery model's going to change over a little bit longer period of time than this lasts as well. So again, those of you that have equity positions or are thinking of taking one on, again, a short-term dent, but again, with some of the resilience, we do anticipate it would bounce back. So what is defined as a recovery? This is just a little bit economics to end my section. Essentially,
Well,
we'll
look,
need
we're
2
talking about
quarters
new
of
practices.
GDP growth from the floor, and we have what we call markers, given the current event, and indicators. The 4 markers we'll be looking for economically, and we'll take this into consideration with business valuation because it'll show us that risk is going down, that we don't have an overload of our healthcare system, that we're at full capacity in testing, full capacity in tracing, and a sustained reduction in cases for 14 days. Let's face it, everybody's looking for that. And then our economic indicators will be the half dozen that have been lifted here, but we're coming off the floor. So that will define recovery, and that will drive the time frame on valuations. But just to conclude that segment, again, where you have been will matter, and where you will be in as short as 6 months will matter as well in recovering business value, because I appreciate the equity position of practice owners is a huge component of your retirement, and that may be happening sooner than later for others. You know, if you read the papers, this was in the Toronto Star last week, there's different shapes to recessions and so on as well. And let's hope this one comes true. You know, in the past, we have had different types of recessions. This is what we call a supply-based recession, much like actually going back to the oil embargoes of the 70s, where the shape of the recession often tends to be more of a V, as long as it doesn't drag on for an extremely long time, which is measured in years, not months. Typically in a demand-based recession like the 2008 financial crisis, we see a U, which takes a little longer to come back. The U with a little more time at the floor and so on, rather than having a lot of pent-up demand, which I think is good for us. And we haven't had an L-shaped recession since the Second World War, with all the stop gaps and market stops and infusion of all the capital and liquidity into the economy nowadays. Government's doing exactly the right thing to push us more towards a V. So I think that is a good thing. Just keeping in mind our clients and so on as well. This is the current client grid. And when you look at these 2 squares over here, you know, we have over 80% of our client, or sorry, 55 to 60% of our clients driving 80% of the business that have extremely high brand loyalty, extremely high PP here stands for pushback points that they will spend. It's a prioritized expenditure, particularly in companion animals and the equine industry as well. Food animals, we believe, will probably be the most resilient to this particular downturn as well. So the segmentation of our clients, even though they may not come back in volume, what we predict is the key revenue contributors over on the left side of this particular grid will come back. So I think our recovery strategies, one, the sooner we can bring that means the sooner that we're there. And I know the CVMA and Grey Wolf are behind that. Dave and I and a few others will be combining on that as well. And the only thing I would remember too is when you continue to communicate with your clients and your staff, this is really out of a marketing slide, but this just looks at the different modalities that clients will use to keep in contact with their veterinary hospital. This is age range here, 25 to 35, 35 to 50, 50 plus, and all of these modalities or platforms, social media or not, where our clients will go to interact with us. The numbers you see in brackets there are the percentage of that age group that goes there to get their information from or search information from a veterinary hospital. So underlying all of this, where we are at now and where we will be on the future, is efficient communication. And just keep in mind, we are very much dealing with a split demographic now, and when we start to recover too. So I'm going to end my section there, and my contact information is there. I've been dealing with lots of practice owners, so feel free to reach out. As a profession, I think we're in this together, and happy to help anybody, and I'll turn it back over to you, Ian.
Thank you so much, John. We really appreciate all your insights. I'm now going to pass it over to Dave. And again, please remember, everyone, if you can ensure that your mics are muted in the lower left section. And then, John, I think you just need to turn your screen over to Dave, and we'll pass it on to him now. So thank you, John.
Yep. Do you have it, Dave?
I believe so.
Okay.
I just need the screen share to stop, and then I can load.
I think you just have to take down your PowerPoint, John, and allow for the screen share in your lower right section there.
Okay, got it now.
So just a reminder to everyone, if a few of you came on a little bit late, my name is Dr. Ian Sandler. I'm the CEO of Grey Wolf Animal Health. Again, we've got some very dynamic speakers with you here today talking about the economics of COVID-19 in your practice. Again, all of this information will be shared on the CVMA landing page. And if none of you or some of you haven't had a chance to have a look at it, it is updated daily. The CVMA has taken a significant leadership role in moving this information forward. So again, thank you to both groups. And with that, I'll pass you over to Dave.
It'll be on the CVMA page too. We can go there and see all the information. Navigating the financial implications of the crisis.
Yes. Good afternoon, everybody. Everybody can hear me okay? On behalf of Ward and Grove, thank you to the CVMA for the opportunity for allowing Ward and Grove to present to the members our current understanding of the COVID-19 relief measures proposed by the federal government. And we would also like to thank Ian and Grey Wolf for spearheading. Just sort of going over our agenda for today. I will be addressing what the current veterinary industry landscape looks like based upon our clients' situations and as well as discussions with some industry partners. Tim Bridge, one of our tax partners at Ward and Grove, will be presenting 3 scenarios that probably one of your clinics will be facing. Along with Emily McRobbie and our HR division will take over and sort of give you some perspective on some HR considerations within those scenarios. I'll just start with Tim, if you want to the page 4 of the screen. So just in discussing with our clients and other industry partners, some of the current industries and how they've been impacted, looking at the large animal sector of the industry, dairy herd and feedlot management, a lot of cattle, calf, swine, and veal industries, limited equine practices, revenues really have not been negatively impacted. They've actually are realizing a bit of a moderate increase in overall services and pharmacy revenues, and they seem to continue and haven't had much of a decrease in the last few days since March 15th. Equine practices, depending on the type of practice, have seen a decrease because of the industry they are in. Mixed animal practices that are dealing in dairy herd and or feedlot management, along with having companion small animal practices that are multi-species. Currently, the revenue is pretty much stable since March 15th. We've actually seen or heard, and a lot of our clients and from other industry partners, that they've had moderate short-term increases simply because of people stockpiling food and pharmacy refills. We would think that would probably start to taper off in April. For large facilities, you know, when you have multi-practices that are going to have a small animal component and a large animal component, you're hearing, you know, we understand that going forward into April, large animal practices are probably, as John had mentioned, are going to be a little bit resilient through this pandemic time period. And in all likelihood, their revenues are going to support, or cash flow is going to support the small animal practice. Yeah. So we may find that they may not actually benefit from some of these COVID-19 relief measures that are being introduced by the government. Then you look at the small companion practice are probably the ones that are going to be the most affected. And we're probably going to find that they'll have the significant expected revenue decrease and disruption in business. And in all likelihood, a lot of it will be relying heavily on the government economic measures that are are being proposed and yet to be legislated. We're looking at list of essential workplaces here in Ontario. The veterinary practices are essential services only for urgent care. So they made it on the list at number 11, and again they've addressed that it's only urgent care. Typically, in businesses that really provide health and welfare of animals, including farms, which brings us to the large animal and equine practices, boarding kennels, stables, animal shelters, zoos, aquariums, etc. Again, this is in Ontario is number 11 and on the essential business list. We urge you to check out your specific province. The rules may vary from province to province. We also look at from the veterinary industry right now. The labor market has been, for the past 2 to 3 years, there's been a very low supply of registered vet technicians, and in some regions there's been a very low supply of DVMs as well. So we have to make sure that we consider that when we are going through these examples or scenarios on what your practice is going to have to do to weather this storm over the next few weeks or months. And we also are, your business is very seasonality.
I couldn't get audio on this thing. I had to call by telephone.
We haven't seen much decline in revenues in the month of March because of the increase in food and medication being stocked up or stockpiled by clients. However, with your upcoming heartworm season, there a lot of practice owners are looking at, for the heartworm season and annual reviews, that's going to be deferred probably till May or June when we're through this. So I think that will be a big consideration in how your practice operates and whether it moves into curbside medicine or telemedicine or deferral of annual appointments to a later date. That's just a bit of an introduction. So I'm going to turn it over to our tax partner, Tim Bridge, and he's over three different cases that your practice may look at throughout. And Emily McRobbie from our HR division will also be speaking from an HR perspective and how those COVID-19 relief measures affect your HR positions. So anyway, Tim, if you wouldn't mind taking over.
Yeah, thanks, Dave, and thanks everybody for joining us. I would ask if you're not on mute right now, if you could just take a second and look at your screen and put it on mute. Your audio will become a lot more clear if we're all on mute. So hopefully that would help a few people that may be having some audio issues. Okay, so as what we wanted to do is we actually want to take some of the government measures that have been released, and there's lots of details out there, lots in the media, lots on the canada.ca website about the technicalities, but rather than just focusing on the technicalities, today we really want to do a case study and looking at some specific practice situations and how these measures might apply to a specific practice. Just before we go on, Ian, is there a way we can just mute everybody on the call? Okay. Okay, so with that, sorry, I've got to jump back here. Okay. So with that, let's look at a small animal or a mixed practice or a large animal practice that, we've got to look at, but we don't expect there to be a 30% decline in revenue. So for a business like this, generally, they were going to continue usual in that we don't expect large revenue decreases, but these businesses still have an opportunity to take advantage of some of the government assistance programs that have been released. So in this case, the one assistance measure that these practices would be looking at would be called, number one, the temporary business wage subsidy. And what that program is it's available to cover 10% of wages for a period between March 18th to June 19th for eligible businesses. And this isn't available as widespread as the new subsidy that's been announced. There are limitations, but generally for most vet practices, especially professional corporations that are incorporated, they would qualify for this. The way it works is there's a calculator that we've included there, but basically you calculate the subsidy, and in order to get immediate cash flow relief, once you calculate it, you reduce your income tax deductions at source for your next remittance period and reduce the remittance amount to the CRA, hence keeping more money in your pocket. The one small thing that you do need to keep in mind is you can't reduce your CPP or EI remittances with this subsidy amount. The other program that would be useful to look into is what's called the Canada Emergency Business Account. Essentially what it is through your existing financial institution, you would become eligible for a $40,000 interest-free loan, and it would remain interest-free up until December 31st, 2022. If you're able to repay it in full by that date, then what the government is doing is they're making $10,000 of the $40,000 forgivable, almost like a grant portion. So again, the banks are willing to do this because the government is backstopping the risk on it as well. So there's still more details to be coming out. Each individual financial institution is doing it a little bit differently, a little bit further ahead of each other. It's something to keep in mind. You know, even if you don't think you're going to be impacted, it's always good to maybe line up that additional credit now. There's no cost to doing so. And, you know, in case things are shut down a little bit longer, or if your projections are a little off, for a little bit of a buffer. You know, there's also been announced by the government significant deferrals of income tax remittances, HST payments amounts, again, just to increase immediate cash flow into businesses. If you're in Ontario, there's also a deferral of WSIB premiums and employer health tax premiums. And in addition, the employer health tax exemption has been raised up to the first $1 million of payroll. So for a lot of practices, that may not be a key point, but again, you'll have to look at your individual circumstance depending on the size of your practice and whether you could benefit from those Ontario measures. And other provinces have came out with other similar measures with regards to their provincial taxes. Now with that, I'm going to pass over the slides to Emily McRobbie, an HR professional in our practice, who's going to kind of talk to the HR side of this case. Emily?
Thanks, Tim. So in case one, with the revenues not dipping to below that 30% loss, you may or may not be seeing any types of layoffs needing to be happening, but you may have employees that still request a leave of absence in relation to COVID-19 for things such as, you know, needing to be home with children who aren't in school, needing to self-isolate, or, you know, obviously being sick or infected with COVID-19. And so the government has passed new legislation under the ESA that allows these types of leaves of absences, and employers must allow and grant these leaves of absences when requested. Can't ask for medical documentation at least to support that leave. The employer would process an ROE and code that ROE with code N, leave of absence. And the employee would more than likely at this point apply for the Canada Emergency Response Benefit, which we may touch on a little bit later. So the other option, if you are you're reducing your hours, of course, now even more so with the new announcement of emergency services only, then you may decide that as a more of a long-term measure, you'd like to implement the work sharing program that's available through the Government of Canada. And so the government has significantly reduced the red tape in terms of applications for work sharing. The employer must prove a drop in at least 10% of hours up to a maximum of 60%. And the employees must equally share this reduction amongst their work unit. So for example, RVTs would be one work sharing unit, and they would equally reduce their hours. Employers must apply 10 days before they'd like that work sharing agreement to start. So prior to this, it used to be 30-day application process, which at the beginning didn't really seem like a viable option, but now they've reduced that to 10 days. So looking forward, if you see that, you know, for the next few months, there will be a reduction of hours, this is probably an option that you should be considering. It's a three-way agreement between the employer, employee, and Service Canada. So everyone must agree to the reduction, and then they would reduce their hours worked in the clinic or on a daily basis. And then for the hours that they're missing, that shortfall, they would claim through unemployment insurance their 55% of those missing hours.
Thanks, Emily. So we're going to move on to a scenario where, you know, the practice owner has sat back, did some calculations, maybe used John's spreadsheet that he presented. That tool looks very useful. Talking with your accountant as well. And what this practice owner is thinking, you know, I'm going to meet, or I think I'm going to be into that 30% decline in revenue. So maybe a small animal practice being hit significantly hard. And, you know, but the practice owner still says, you know what, with the assistance available, I'm still going to keep the clinic open, and I'm going to move forward and take advantage of the programs that are available. So again, a small animal practice owner, and we're say a 35% revenue decrease in monthly revenue. And the practice is made up of one owner DVM. He works full-time in the practice. He also has two DVM full-time associates. So this practice has 1.785 million of gross revenue annually, roughly each DVM servicing 595,000 of the revenue base. And those two associate DVMs are on a full-time salary of $95,000 a year. To support those doctors, the practice also has 5 full-time equivalent RVTs. And the RVTs in this practice are paid $22 an hour, and they're working 40 hours a week. So 2,080 hours per year. So they're making $880 pay per week. So as of right now, and as we are speaking, I understand the government is making further announcements. So as with all these measures, they do change day to day. But as of right now, this practice would qualify, and it's currently proposed. It's not legislated. So again, we're waiting on details. But they would qualify for the Canada Emergency Wage Subsidy, which is generally 75% coverage by the government of the wages. There is a specific formula in place. It's not simply the 75% of the amount paid, as you'll see. So the first requirement that the government is saying is the employer must attest that they would have that 30% drop in revenue compared to the same period in 2019. And again, when they're looking at revenue, they're talking about arm's length, meaning sales to external customers. Their government is appearing that they want to get the money out as quickly as possible, but they are saying because of that approach that there will be significant penalties for those who try to take advantage of the system, whether that would be to try to not report revenue properly or try to misuse these rules. So again, they're trying to get money out quickly, but we do expect very significant penalties and a very more rigorous audit program, perhaps, than what has been in the past. Right now, they're saying there'll be 3 claim periods. The first starting retroactive back to March 15th to April 11th, and that's going to look at March over March revenues. Again, as Dave kind of alluded to, we don't see a lot of decrease in that period for certain reasons, so that may or may not be available, but really looking forward to the other 2 claim periods, April 12th to May 9th, May 10th to June 6th, based on April and May revenue decreases. And while there isn't a lot of guidance right now, the government is saying revenue would be calculated using normal accounting methods. So basically your consistent method of keeping your books, excluding extraordinary items and capital amounts. So, you know, if you were to sell a piece of equipment, which is capital, that wouldn't impact your revenue. So as far as applying these wage programs and subsidies to those employees, we would look first at the 2 associate DVMs. Option A, would you just decide to lay one of them off? Well, if you did lay one of them off, that laid off person would be applying for the Canada Emergency Response Benefit. And those applications started this week, and that is providing $500 a week, $2,000 a month to eligible applicants for the DVM. That would compare to their normal pay of $18.27 a week. This laying off one of them does raise other questions, though. You know, what happens when business rebounds? Do they simply get called back? How quickly have they moved on? And how would you choose one out of the 2? That, you know, in practice, that might actually be difficult. Easy for us to move a number on a spreadsheet, but dealing with people is a different matter. So let's say we don't feel comfortable with just laying one off and keeping one. Why don't we look at keeping both on staff and potentially reducing their normal working hours? In this case, you know, we could leave the wage at 100%. The government is trying to encourage that. So if you did that, you would apply for the Canada Emergency Wage Subsidy for both of those associate DVMs. So if you left the wage at 100%, they're normally paid $18.27 a week, and the government subsidy would come in for $847, leaving your cost at $980 per week per DVM. Alternatively, even if you thought, oh, geez, I really want to do as best I can, but I don't think I can cover that cost with what I'm projecting. You know, maybe I would reduce their wage of both of them to $847 a week. And it's interesting with the formula, the subsidy still stays at $847. It's not a simple 75% of $847 due to the formula. In this case, the employer cost is essentially nil, except you do need to still pay CPP and EI premiums. But you know, the associate DVM is still $347 a week ahead of the other alternative of $500 on CERB. So it's just some interesting math, you know, looking at that difference. Also, is there opportunities for a work sharing arrangement, as Emily kind of talked about, or can we still use their capacity maybe for other ways to provide services in the practice, such as telehealth or other maybe new ways of providing service to the clients and reaching out to those clients. So now that we've kind of looked at the associate DVMs, what do we do with the 5 RVTs? Again, same thing, we could decide to lay some of them off and they could apply for the CERB, $2,000 a month for them. But again, the same questions, what happens when business rebounds, how to choose which are laid off. You know, we think in the long term, with demographics, the labor market is still likely after we come through this to be quite strong. And the risk of losing valuable employees is certainly a risk. So what the practice owner might alternatively try to do is keep all of those RVTs on staff with 100% pay and to choose to apply for the Canada Emergency Wage Subsidy for all 5. In this case, the RVTs would keep getting paid $880 a week, regardless of the amount that they are working. There would be a subsidy of $660 a week per RVT coming in, leaving a cost of $220 a week to clinic. And again, we just put that out there. Are they still able to offer different sorts of services to clients or to the clinic during this time? The other alternative with the RVTs would be keep them all on staff, but say they would reduce their pay to maybe 80% of their normal pay.
So Hilla's on the phone.
Again,
Hilla?
the practice would apply for 75%.
No more refills of the peanut butter.
Sorry,
Whoever's
folks, somebody still is not muted. Somebody's trying to refill a prescription. If someone can just make sure that they're muted, please.
I think it's the superstore on Schoolhouse. I'll double check
Thanks,
with her. She wants to know, are you able to fax it over there? Yeah.
Okay. If you're not on mute, can you please double check that? You should see a red icon beside your name. Okay. So again, reducing pay to 80%, but applying for the subsidy for all of the 5 RVTs. So you may reduce their wages to $704 a week down to an 80% level. The subsidy in this case would still be $660. So in this case, the employer's topping up an additional $44 a week. It makes you take a look at basically the spread though, you know, for $176 less per week than the 100% scenario, to save the spread of $176, is it worth some of those risks of that may come with doing one versus the other? And you know, in either case, still the RVT would be better off. In this case, $704 a week compared to $500 on the CERB. Really, what I'm trying to get at is you really need to work with your advisors and do the calculations specific to your practice to see, kind of do those projections like what John had mentioned, to see what the impact is and how you can best manage the situation. Again, under these situations, you would still have to attest that the business is doing everything possible to pay those full wages. But again, reducing the work hours equally to share the remaining work amongst the team may just be the only way that you can make things work. So again, that kind of deals with the employee side. On the business measures in general, you know, again, I mentioned that Canada Emergency Business Account, the $40,000 loan for your financial institution, the other deferrals or additional exemptions. But again, I think the big thing too is getting on the phone with your advisors, specifically your banker. And John talked a little bit about freeing up cash flow in different ways. But again, looking at your lines of credit, maybe a bulge is appropriate. Looking at your amortizations on your loans, pushing some of those back. And I think John did a really good job of kind of outlining in detail those things. So we're just kind of saying the same things, but again, keep the communication up with your advisors. There's still lots of opportunity and assistance out there to get people through this. Everybody is working together. So I kind of mentioned, you know, kind of the number side. I'm going to pass it over again to Emily to kind of just talk about the HR implications of some of the recommendations I made.
Thanks so much, Tim. And just to be cognizant of time, Emily, we've got about another 3 or 4 minutes on the call. So if maybe you can just take a couple of minutes and sum up, and then I'll come on right at the end. That would be great.
Absolutely. So just in terms of risks, I won't go as deep as I was going to go, but in terms of case B, you just want to make sure when you're making any changes to the employment relationship, whether it be a reduction of hours, whether it be a temporary layoff, ensuring that you're having those conversations with either, you know, your legal advisor, your HR advisor, and ensuring that you understand what the risks are in terms of that and mitigating those as much as possible. If you're talking about temporary layoffs, then more than likely they're going to be, especially if you're at that over 30%, it's more than likely that will be a factor for you. So you're going to be looking at that CERB benefit for those employees. And if it's a reduction of hours, potentially you're still taking into consideration wage subsidy and or work sharing, or a combination of all three. And then of course, just ensuring you have a defendable process in making all of those decisions. So whether it be who you're choosing to lay off or who you're choosing to reduce hours for, just ensure that you have a defendable process for who you're choosing to have impacted by this.
Ian, I don't know if we have a minute for Dave to kind of just wrap up some key takeaways that he's seeing.
Sure, Dave, please go ahead. I think we've got the line just past 1 o'clock. So if anyone wants to just stick around for a few more minutes, we'll just sum up here.
Okay, thanks, Ian. Just some key takeaways. I think John's worksheet that he provided, and you can, assess how April, May, June will look for your clinic is going to be very helpful in determining where your practice is going to be in that time period, and to keep, with everything being so fluid, I think you have to remain fluid as to your decision processes. Whether you're going to lay people off, whether you're going to downsize, whether you're going to provide curbside medicine, whether you're going to provide telehealth medicine and so on. I think you just have to kind of be cognizant of that this is very fluid and things will change. And, the main thing is, and I think what the federal government is telling us, is to try and keep your employees on payroll, not only for economics, but also for retention purposes. Once we're through this, that you still have, once you ramp up and start going again, and your heartworm season is maybe delayed, but you're back into it, that you have the staff and the capacity to do that. And we do be sort of, as Prime Minister Trudeau has said, just be very careful that we don't tax, or we're not going to try and tax plan around or misuse or abuse any of these relief measures that have been introduced. And really, for your practice and practice health and your own health, make sure to reach out to your accountant, bank, or legal advisor, because we're all here to help. We're all in this together, and I think we'll all get through it together. And there is another side to this. Ian, we certainly appreciate the invitation to present to the CVMA, and we also like to thank the CVMA for giving Warren Upper Grove an opportunity to present this. There's lots of links that we've included in our slide deck as well, and by all means, either reach out to Tim, Emily, or myself if you have questions. You can find us on our webpage. Thank you very much.
Thank you.
Thank you so much, everyone. And I just want to take a couple of quick moments to finish up today, just by saying I'm very proud to be Canadian. I'm very proud to be a veterinarian. I've been in practice for over 25 years, and now as I'm shifting to industry, seeing how so many of you on the front lines have given things like your personal equipment that you are putting in hands of frontline human workers, and really, putting them first is incredible. The CVMA sent out surveys regarding ventilators, and I'm happy to say that many of these ventilators have found their way into human hospitals. So I would say these are incredible times, but I also think they're incredible opportunities. Educating your clients and your staff during this period, people are looking for activities. So quality education, all of those kind of training seminars are great opportunities for you to utilize your staff right now. The idea of telemedicine, and again, CVMA is focusing on that, and also being in touch with all of the folks that are helping you, your consultants, your advisors, your accountants. So again, a big thank you to Dave and his team, to John Tate, and to the CVMA, and to all of you. As John mentioned, there will be a follow-up from this webinar. We will be doing one in the next several weeks, so we will keep you posted on that. Shortly this afternoon, there'll be another webinar on telemedicine